So Meta finally reported earnings, and I've been watching the stock since pretty much over $300 a share, and I've seen it go from $300 a share to $162 a share right now, and I still personally haven't bought Meta. So in this video, we're going to talk about the earnings, see if they are good or bad for Meta stock, and I'm gonna say why I personally haven't bought Meta stock yet, and when am I be going to buy the stock, and maybe talk about my updated valuation model as I had to re-update the model and change it a little bit, mainly after their guidance and couple of other things that changed with the company and earnings. So again, I hope you enjoy this video. First of all, I have to be honest, I am very disappointed with the earnings of Meta. I mean, every single quarter is pretty much worse than the other one. Every time the guidance is lower, they miss on a couple of other things, and it's just really been getting bad. And I hate to say it because I think it's a great stock, but again, this is just reality. So to get started, the revenue in the third quarter will be in the range between 26 billion to 28.5 billion. Now the average analyst estimate was 30.5 billion, decline of 2% and 11% from a year ago. So the best case scenario, it's a negative 2%, and the worst case scenario is negative 11%. And this is the second consecutive quarter I believe Meta stock actually declines in revenue. And this is really not a good sign at all. And there's actually two reasons why this is happening. The first one, the company mentioned that the advertising demand, environment, was expected to slow, mainly because of the macroeconomic uncertainty. And the main thing is, my argument is that, okay, the macroeconomic uncertainties are bad, and the Meta CEO is right, because whenever you're in a recession or you have an economic slowdown, the first budget that companies cut is advertising. But again, Meta got affected by it, but why Google didn't? Google beat on their estimates and guidance for their ad revenue, but Meta didn't. So why didn't this whole thing affect Google also? Is it only a Meta problem, or is it an entire sector problem and it's not Meta's fault? This is what I'm trying to find out. So I'm waiting from earnings from other type of companies in the advertising space to kind of see what they are experiencing, if they're experiencing the same thing, so I can determine if this is a problem within Meta or if it's just a problem, in general. But again, if Google is not being affected by this right now, it's going to be affected in the future, because ad spending going down is imminent in the recession we're in. That's going to get much, much worse in the future. And the second reason why is because, their guidance, they assumed a foreign currency loss of around 6%. And you've been hearing that a lot, I bet, from companies like PayPal and many other companies. This is mainly because the dollar has been very strong and it has been going up. And whenever that happens, companies suffer currency losses. And whenever, the dollar moderates, they may actually get gains on currency, or they may actually just, break even, on normal, just like what's been happening before. So this is again a temporary problem because Meta is so huge and international, but it's not going to be here forever. So this is the two main reasons why this is happening. Looking at the net income, which again disappointed me a lot, this is the third consecutive quarter, or the second, where net income actually declines. It was 10.2 billion in net income in Q4 of 2021, and now it went to 6.6 billion. That's over a 40% decline. That's pretty bad. The last time it was, like that, it was 7.8 billion around the Q3 of 2020. So many people say, Meta stock is trading, lower than it was in 2020 or lower than it was in 2018, and now it has more revenue. Yes, but the growth is slowing down, and this is a big problem with those companies. Whenever the growth starts slowing down and the net income starts going down, this is a pretty bad combination, which kind of leads stocks to reprice to lower multiples. And again, Meta is cheap. Meta is much cheaper than it was, but it's not cheap enough in my opinion. And I really hate to say it because I love the company. But if you look at Meta's recent EPS, which is $2.45, and if you actually get the $2.45 or $2.46 and annualize this EPS, you get around 17.5 PE on Meta stock according to the latest share price. So 17.5 PE for Meta. You could get Google for 19.5 to 20 PE, which has a much diversified business model and multiple streams of income, and also you get higher revenue growth and a pretty good balance sheet too. So again, Meta is cheap, yes, but on a relative basis to something like Google, Meta is still not cheap enough for me. And again, I hate to say it, but this is just the truth, with the company. Looking at the capital expenditures again, Meta continues to spend over $13.2 billion on just capital expenditure, and this is only year to date. So the whole gamble with the metaverse, I believe it's the gamble of the century, because if it ends up actually working and it becomes, something pretty huge like the internet or whatever we had before with the whole, messaging apps and stuff, if the metaverse really becomes this huge and Meta has a huge market share in that, the company is going to experience massive revenue growth, maybe 10 to 15%, even 20% revenue growth again. And then the valuation is going to reset much, much higher. This is if everything goes good. But if everything goes wrong with the whole metaverse idea, it's going to be a very costly mistake, not just for the company, but for the shareholders themselves. So it's a pretty big gamble. And I think Mark Zuckerberg, he knows what he's doing. But again, some things in life, they just never work. Sometimes they do, and sometimes they don't. And we have to be open to both scenarios. So looking at their earnings report, actually, the revenue declined. We talked about it. Research and development went up a lot. General administrative went up over 50%, which is, again, something I didn't like. But Mark Zuckerberg actually talked about kind of, reducing some staff and freezing hiring and many other things. So now I think he's finally doing the right things. Maybe he's spending a little bit too much on, general and administrative and those type of expensive. I think he should take it a little bit more conservatively. But again, something we all like about Meta is the share buyback, and the company bought back more shares in the quarter. The total buyback, I believe, is around 4 or 5% of the market cap every single year, which is a pretty amazing way, and it's Warren Buffett's favorite way to actually return value to shareholders, in mainly with buying back stock. Because whenever you buy back stock, you reduce the number of the owners in the company, which gives you a higher ownership in the business. It's pretty amazing. So again, we talked about the good things, we talked about the bad things, and now it's time for my valuation model to determine if Meta stock is a buy right now, or if everything is justified with the whole risks, or if it's maybe still a little bit expensive and we should maybe wait for a better price. So this is my valuation model on Meta. It made around $118 billion of revenue in 2021. And many of you may disagree with me on this, but Mark Zuckerberg, he mentioned guidance of 8 to 11% growth. And again, he revised this guidance lower, and things came way worse than expected. So in 2023, at least the half of 2023, we're likely going to be in a big economic slowdown, and we're likely going to be in a recession all of this time. And the CEO himself mentioned the risks of macroeconomics, which actually really reduce ad spending, which hurts Meta. So I took the revenue growth down to 6% for those 2 years. Again, it could be conservative, but it wouldn't surprise me, as Meta surprised me every single quarter. So I think 6% is pretty fair in an economic slowdown, and companies will pull back much more than they did on ad spending. And then I used 8%, which is the lower end of his estimate for the next 3 years. And I believe this is something pretty fair. And many of you, again, may agree or disagree with me on those growth numbers, but I like to be conservative and use the lower end of the range, not the higher end of the range. So again, 8% and 6% growth, using the same net income margins they have right now, which is around 24 to 25%. PE ratio, I used 17, and many of you, again, may disagree with me on this. 17 is the PE ratio they have right now, based on their latest EPS. And I personally believe that, whenever a company gets more mature, the revenue growth slows down. And whenever the revenue growth slows down, the multiple has to come down. And Meta always traded lower than, Google and Microsoft and all those companies mainly because of some political risks and also the whole thing with the moral hazard around buying Meta, which many people talk about it. And I don't personally implement this strategy. I try to focus on the business itself. But again, many funds and hedge fund managers and individual investors actually have some kind of moral hazard around, Meta and the company, which really prevents them from buying the stock, and it was always trading cheaper. So again, with ad spending going down in the future and the growth slowing down, I believe Meta would never trade at a 25 PE again unless Metaverse was a huge success, and this is something I'm not counting on. I'm just counting on the core business. And as Monish Pabrai said, it's like you're buying the core business, but the Metaverse is like a call option you have that may pay off and may not. So it's best to focus on the core business. And I believe 17 PE is a pretty fair estimate for Meta. With a market cap of 700 billion, you only get a 61% upside or 10% compounded every single year, which is pretty low. But again, if we use the higher end of the PE ratio, which is around the 20 PE, you get around 90% on the upside over the next 5 years or 14% compounded, which is really not bad at all, especially if you factor in the buybacks 4 to 5% a year. The total return could be over 100% upside over the next 5 years. So looking at this thing, Meta may look like a buy actually at today's prices, but I personally haven't bought Meta yet, and my main buy on Meta is going to be under $150 per share, mainly because I have a lot of exposure to the advertising industry. I own some, kind of streaming stocks, some old, type of television channel type of stocks, pretty hated stocks. And I believe Warren Buffett agrees with me because he owns Paramount. He sees some value over there. So I have, pretty kind of a lot of exposure in this industry. And Meta is an amazing company, but I want it as a pretty fair price because Meta may not trade at a 20 PE 5 years from now. Maybe the growth will be 4 to 5% a year, the way things are going with a lot of competition and a lot of uncertainty in the inflation and the environment, which we haven't seen before. So again, a 17 PE, which is just like right now, would only be a 61% upside or around 80% with the buybacks. This is not worth the risk reward for me. So I'm going to wait under $150. I'm going to open a small position and then average into it as Meta goes down. I believe Meta could trade between 100 to 150 or 160. Over the next few months at least, until the whole uncertainty goes away, and maybe Meta can trade just like it traded before again. But this is my valuation model, and this is why I haven't bought Meta stock yet. So I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.